All right, welcome back to the Jason Gray Show. Two huge reports coming out over the next 2 days. The CPI report and the PPI report, which is the Consumer Price Index and Producer Price Index reports, are both coming out. And these numbers will make or break us over the next few months. Like we've been talking about, this May 10th and 11th date are really important, but some information came out by Goldman Sachs and Chase over the weekend saying that their numbers are going to be showing way higher than what the street is anticipating. So they're thinking about a 0.3 report, but then Chase and Goldman Sachs both came out with 0.4. So this could be an interesting next few days. So in doing so too, it might create a situation where our mortgage rates maybe not quite go as quickly down as I thought, but in the long, if you look at the next 6 months, it's all trending in the right direction. So let's sort of see what happens. If you're floating, don't float your interest rates right now. Lock your rates before these reports, because this could be, a couple little sketchy days. So let's go and go to the charts. So let's look at the monthly core report, the CPI readings. This chart that you're looking at right now is brought to you by Barry Habib at the MBS Highway and his team. They do great research. They're fabulous at what they do. They dig into these reports, and I have the luxury of listening to him daily, try to figure out what the market's doing so I can relay that information to you and what I think is going to happen through what they're telling us. And there's a couple people that I follow, and they're all saying the same thing. So I want you to look here, and I want you to look at the April 2022 timeline. And then you're going to see to the far right-hand side here, you're going to go and see the 2023 reports. So if we look at the 22 reports, these were revised down by the FEDS. And in doing so, it's going to create a situation where maybe these numbers don't, like I say, give us the push I thought we were going to get over the next couple of days. It might take an extra couple months, but this is all coming. Mortgage rates are going to improve, and we're going to tell you why. So if you look at the April, May, and June numbers for 2022, we're replacing those numbers, which were high numbers, and we're anticipating the numbers come around 0.3% like we were talking about. Like I said, Goldman Sachs, Chase thinks it's going to be a 0.4 or 0.43 read, which will definitely hurt us, but that's okay. Over time, this is going to continue to go down. I'll explain to you why further in the video, so please watch. Now, you're going to see July, we have a really low number here. That's going to possibly hurt us a little bit. Then we roll into August, September. All these months right here for the next, 6 months, should transition to where mortgage rates will start improving because the inflation numbers come down. You got to keep in mind, too, replacing old numbers from last year. So if we were hitting these high inflation rates of, let's say, 10%, and you hit 10% again year over year over year over year, then inflation gets way out of control. But what we had is a supply chain issue, and then inflation went up. And what we're doing now is we're replacing year-over-year numbers, and that inflation is going to come down. Now, does that mean that our gas prices and food prices are going to come down? That's something definitely to talk about. So let's go ahead and talk about this next chart. And the next chart is just talking about how the Federal Reserve and the Feds and their numbers came in and revised their numbers down a little bit. That's why you're going to see this before and after revision, and you're going to see it on the charts here. That little jagged line in the orange, you can sort of see tails to our advantage here at the very end of the year. You can sort of see how it dips below. That means those numbers are going to look better for us when we roll to the end of the year. Still, mortgage rates should be going down. So now let's look at the next chart. It's the shelter replacement cost, and this has been a big number because there's such a big weight in on shelter costs, and this is a number that I want you to take a look at. Take a look at the very far right-hand side, and you see the March number. It came in at a reading of 0.56%, and it should have been even lower, but the, what do we call it, like the VRBO rentals, those numbers came in incredibly high. When those came in incredibly high, it actually affected our numbers here. So you can sort of see our trend here is where we had these really high shelter costs, and then it started dropping down. Since these reports are so weight-bearing in regards to housing and shelter costs, these numbers should be looking good, and it's going to continue to go down. I think we're hitting a trend. Let's go to the final chart here. The final chart is what they call as the lagging shelter cost indicators. So you can sort of see this big bell in this purple line, and then it goes down, and it goes down steep, right? Well, you take a look at the CPI looks at a year-over-year average over the 12 months, and you can sort of see that other reports still going up a little bit. But that bell curve's hitting where these rates are going to start coming down in regards to the shelter costs. These numbers are going to come down, and it's going to roll into the CPI report, and it's going to actually bring those numbers down. So if you take a look going forward, since this is a lagging indicator here, as we look forward, this is going to get looking better and better and better over time. So that's why I'm anticipating mortgage rates coming down through the end of the year. So let's go back to the Goldman Sachs Chase issue. Now, the reason why they are revising their CPI report up is because of oil cost. So oil costs made it down to like $63 a barrel, then went up to $80 a barrel, and then it's now starting to trickle back down again a little bit. But these have to deal with reports out from last month, and so in doing so, we have to deal with those reports. Now, there's plenty of people that are saying that this report's going to come in at 0.3%. And if it does, then I think it's a huge catalyst in regards to mortgage rates going down like we originally anticipated. If it doesn't, it comes in closer to the Goldman Sachs Chase, that means rates are still going to come down, but it's going to slowly but surely trickle down over the next couple months. And I am really anticipating by the end of the year, we're in a completely different environment in regards to where mortgage rates are. We are truly dealing with struggles with housing. In this market that I'm in right here, there's multiple offers on just about every house right now. And clients are having to come in with like all cash offers, waiving contingencies. I had a client the other day waive $100,000 non-refundable earnest money on a deal and waived all contingencies to win a deal. Those are the things that are happening now. So if you can imagine what's going to happen when mortgage rates come down, it's going to get worse. So if you're just on the fence post of regarding, should I buy or should I not buy? Buy now, because, Coach, no financial advice, but I'm sort of giving you some advice, but no financial advice. I think housing market's going to go crazy. And when that does happen, then, we can refinance when mortgage rates go down. And then you have equity in your house, and you're building equity into something. Housing is the biggest wealth for any person to build wealth in the United States. So out of anything, between stock investing versus anything else, housing is the best investment you could possibly make. If you have any questions in regards to mortgage financing needs, the information I'm giving you here, please go ahead and put your comments below. I'll respond back to you. Please like and subscribe if you like this content. Talk to you soon. Bye-bye.